Welcome, everyone, to another episode of Smokin' Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the opportunity to speak to Bonnefield Financial, which is Canada's foremost provider of land lease financing for farmers. So thank you very much, Andrea Gruza, for joining us today to talk about Bonnefield. Maybe I'll turn it over to you for a bit so you can describe to us what Bonnefield is and how people are using it. I believe you have a slide deck for us that we can jump to as well, but maybe introduce yourself and Bonnefield a bit.
Great. Well, thank you so much for having me today. I really appreciate the opportunity. By way of background, I am with Bonnefield. I've been with the firm for about 4 years. And for those who aren't familiar with what we do, we're Canada's largest farmland investment manager. And what that means is in 2010, the business was started with a view to trying to find a way to provide farmers with an alternative source of financing to help their businesses grow, to help them transition the farm from parents to kids, basically for whatever need those farmers might have for financing that's different from traditional debt. And so at the same time, we wanted to find a way for investors who were looking for a way to get exposure to Canadian farmland to have this opportunity without maybe going out and buying a farm of their own. So we married those two ideas, and over time, the business has grown. We invest on behalf of both institutions, so Canadian pension funds, as well as individual Canadian investors. And we use those funds to help our farmers through a sale leaseback financing. So we'll acquire some of their acreage, lease it back to them on a long-term basis. And as a result, we have a big portfolio of farmland coast to coast. So that's the business model in short.
Wow. Okay. Well, that's unique. I mean, Dave and I started looking at Bonnefield because of the uniqueness of it. It's an opportunity to like you say, a unit holder or an investor to take part in owning a piece of farmland without actually becoming a farmer. So a real for us as wealth managers, a real diversifier to a portfolio. So that's what initially sparked our interest. So we're excited to learn more about it. Andrea, do you want to maybe jump into your slide presentation so we can learn more?
Absolutely. And I thought what I'd do today is start at a really high level, because I think a lot of people don't necessarily think about agriculture as an asset or even an asset class. I think a lot of investors are familiar with equities and bonds and maybe starting to get comfortable with the idea of private equity, infrastructure. But when you say agriculture, I mean, even I, 4 years ago, before I came to Bonnefield, didn't necessarily realize and appreciate that it could be an investable asset class. So I am going to share my screen. Excellent. So first of all, when you say agriculture, I think lots of people think about different things. And so agriculture and agribusiness really does cover a wide range of businesses. And the way those businesses operate and what drives their revenues can be very different. So as an investor thinking about getting exposure to agriculture, you can do it all the way across the value chain. And it's good to think about all the different opportunities to make sure that it's the right fit for your portfolio. So you can think about, within agriculture, starting from the very beginning, the inputs, seed, fertilizer, other chemicals. That's, within the ag value chain. Then you move along, think about production. So how are the crops actually being produced? That's where the land piece fits in. Agriculture doesn't just think about cropland and livestock. It also includes aquaculture. So, not always something people think about when they think about ag. You can then continue to move down the value chain, think about processing. So those facilities that are taking those grains and inputs or crops that were grown and actually doing something with it, milling, grinding, and then all the way through to the distribution channels that are getting them to the shelves. I'd say once it hits the consumers, once it's really branded, sitting on the shelves of, the grocery stores, I tend to stop thinking about it as agriculture, start thinking it a bit more as consumer retail. And certainly, marketing and other trends factor more into its revenue generation than anything within that traditional ag value chain. But those are kind of all the ways in which an investor could think about getting exposure to the ag value chain in their portfolio. What is common about all of them, though, is that they're all being influenced by these macroeconomic drivers of agriculture. And these are really demand and supply dynamics. I mean, there's many of them, but I've tried to simplify and just give a really high level here in terms of like, when you think about agriculture, why do you want it in your portfolio? Well, let's think what's happening in the world today. We have a growing population. We have changing dietary habits. We have less arable land for a number of reasons. Development that's happening, in Canada, it's happening globally. Think about, urbanization in other countries. They're taking farmland, they're turning it into big cities. We're having climate change impacts that are making certain parts of the world less favorable for growing crops. We see it just, to the south of us in the US, where growing conditions are becoming too hot for certain crop types and the yields are coming down. So that's, and then add to that water scarcity. Again, something the US, South America, Europe is really struggling with. That's not to say in Canada that, we don't have an issue here or that we shouldn't take it seriously, but obviously in parts of the world, you're having that impact. And so that's resulting in less land available to grow the crops that we need to feed a growing population. So that creates a really attractive opportunity from an investor perspective, to be able to gain exposure to those assets that are going to continue to be more valuable because they're becoming more scarce and because we're relying on them more. So those are kind of the high level macroeconomic trends that I like to point out when investors are thinking about why they may want agriculture in their portfolio.
Nice.
I think, in terms of thinking about where and how to invest in agriculture. As I sit here today, certainly I mentioned we are a farmland investment manager primarily. So we're, offering open-ended funds for investors to gain exposure to the farmland assets. But there are other places to think about and look. And so I've kind of outlined here on the screen some of the key areas that an investor could think about investing. Not just farmland. You could think about the infrastructure, the processing facilities. You could think about investing in commodities and playing the commodities market. Maybe into equipment or ag tech is very popular right now. But really, in thinking about all of these things, it's important to consider what role are you looking for it to play in your portfolio? How involved do you want to be? Do you actually want to go and buy that farm yourself and then lease it out to somebody? Do you want to become a farmer? What's your risk threshold? I mentioned ag tech. There's a lot of amazing technologies coming online, but some will become adopted and others won't. And so you need to think about, are you looking for a higher risk investment, or are you looking for something different? And then what returns are you looking to achieve? So is this somewhere that you want to be generating a lot of income? Or is this an investment that you want to set it and forget it, park it in, it's almost becomes your savings account and you're invested in it and it's going to appreciate over time, maybe be fairly low in volatility, but you don't need to touch it for a number of years. And so it's really important to ensure that you're thinking about all of those things when you decide which asset, which model to pursue in terms of your agricultural investment. So with that said, I'll spend a bit of time talking about what we're experts in, which is farmland. I will point out, so Bonnefield is only investing in Canadian cropland. We're not doing livestock or dairy, and we're not invested in other parts of the world. We're really focused on supporting Canadian farmers through our sale leaseback solution. But really, when we think about why farmland fits in an investment portfolio, we think about it from a few different perspectives. But really, a lot of our investors are looking to find an asset that has very little correlation with other asset classes. So what we've done here, and you can see the pie charts on the screen, we've taken, a traditional portfolio mix, 60% equities, 40% fixed income. And we've looked historically at what the return would have been on this. And then what the return per unit of risk is in that investment. And that's sometimes called a Sharpe ratio. So this is kind of an effective Sharpe ratio, thinking about for every additional point of return, how much risk am I taking on? How much additional volatility might be in this portfolio? So you look at that on kind of your traditional mix. When you start to add in traditional real estate, so think kind of commercial real estate, some of your REITs, that's what you see in the middle. And what we've done, you effectively have roughly the same return. But you have actually increased that risk return number at the bottom, meaning you're getting more return for less risk. We've then on the far side added in Canadian farmland. And what you can see again, really you're not impacting your returns negatively by any means. And in fact, historically you would have increased them, but your return mix, or sorry, your risk profile decreases again. So what you're doing is you're really kind of reducing some of the volatility because you're putting in a more diversified asset into the portfolio. The other thing about Canadian farmland is that it tends to be not, counter-cyclical to the rest of markets, and it performs very well in those times that you want it to perform well in. When we launched our initial fund, we were coming out of the financial crisis in 08, 09, and there was a lot of thinking around find an asset that protects you through this market volatility, and that's what you see here. So on the left-hand side, we've actually taken some major points in time where there were meaningful global market sell-offs, and you can see the way the global equities markets behaved in those periods. That's the gray line; they were all negative. And then we've mapped out U.S. farmland and Canadian farmland. And you can see for the most part, both Canadian and U.S. farmland performed well and actually had positive returns in those time periods. Canadian farmland actually in all of them, U.S. dipped a bit in one of those periods. And, the other piece here that we often get asked is around inflation. And a lot of people are wanting to be exposed to farmland as an inflation hedge. So you can see on the right, historically, Canadian farmland, as shown in the green there on the right-hand chart, tends to outperform in periods of high inflation. And that might not be intuitive to people as to why that is. But if you really think about what the drivers of farmland returns are, it's farm profitability. Who is actually going out and buying farmland and who's most active in the market? It's farmers, it's farm operators. And when they have more cash in their pocket, perhaps because of strong, harvests, but compile that with high commodity prices that you tend to see in a high inflationary environment. They have more cash in their pocket. They invest in their businesses. They want to grow the business. What's the first thing you do when you want to grow your business as a farmer? You buy more land. You can't grow more if you don't have more land. So that's the, at a very simplified level, the relationship between, inflation and farmland values. And so coming out of the last year, this was a very strong performing asset, and it was expected to be a strong performing asset because we have been in a volatile, high inflationary environment. The other thing I touched on at the beginning, but I think is really, really important, and Dave and Tyler, I assume most of your listeners are Canadian, but maybe not. I think as Canadians we forget how special our backyards are. We don't realize how fortunate we are to be in Canada. We have vast natural resources, access to fresh water. We are not struggling with a lot of the issues that many other parts of the world are. And I think that makes Canadian farmland extra attractive when compared with farmland in other geographies. So, the first thing is to think about is why farmland in general, and then why Canadian farmland. And so with respect to why Canadian farmland, you look at this chart, this map, it was done a few years ago, but at the time of this study, the blue sections represent areas of the world that didn't have the ideal growing conditions in place at that time to support a single major commodity crop. That isn't to say that they weren't growing them, subscale, but those ideal conditions weren't there. But that by 2060 to 2080, you would have shifted the growing conditions to have them support that ideal, have the ideal conditions to support a cash crop. That's huge. Where is the blue? It's in the northerly latitudes. It's in Canada. It's in Northern Europe and primarily Russia. And, nobody's putting their money into Russia these days. So that says a lot about what's happening with Canadian farmland. So being exposed to Canadian farmland today, it's being valued based on what it's producing today. But that production is shifting, and we're seeing it within our portfolio. And, farmers are doing it today in Canada that over the last 5-10 years they've moved from some low value crops to be doing test plots or even full production of higher value crops, which then raises the value of the farmland. So really just a summary, I think Canada specifically has a number of diversified crop types. Climate change really is relative to other regions to our benefit. Water availability would be the other piece that I would speak to. Very little of our farmland is irrigated. About 2% of overall farmland uses irrigation. We're able to properly irrigate our farms with fresh water and rainfall, which is very different. And we have a really well-supported industry with incredibly, sophisticated, professional, leading operators. So it's, a really attractive industry to be exposed to. So I'll pause for a second because I've talked a bit about the asset class in general. Before I move into anything related to Bonnefield specifically, I just want to see if there are any questions.
Yeah, I guess just when you look at that last chart about the risks and, from political and things of that nature. I mean, obviously Europe, there's some really strong headwinds with reducing farms, reducing fertilizers, a big push there. Now, I guess in Canada, we did have a little bit of a discussion about that. Where has that gone compared to Europe?
It's a really good question. You're right. I mean, Europe has very different dynamics in terms of size and scale than Canada does. But yes, there's been a lot of noise coming out of Europe and requirements to reduce fertilizer usage. I'd say the industry as a whole globally is under, I don't want to say pressure. It may feel like pressure to in some cases, but is being looked at to ensure that sustainable operations are implemented. And I don't expect that in Canada to mean we can't use fertilizer or we have to stop using pesticides. That's not sustainable. For something to be sustainable, it has to support everyone for the long term. And that means it has to be economically viable for the farmers for the long term. And it means that it can't be destroying the world. It can't be contributing to something negative. So I really do think that, yes, there's going to be more of a push to ensure that farming is sustainable. But the reality is high quality farmers, especially in Canada, are doing sustainable or even regenerative farming already. I mean, most of our farmers in Western Canada already do some form of low till or no till. Many farmers in parts of Ontario are doing cover cropping. No farmer is using more inputs than they have to because from a basic perspective, it's expensive. Why would you do that? And very few farmers, if any, have a 1 or 2 year view. They have a 50, 100 year view because this is farmland for their families. So I actually think the regulatory piece and the concern around sustainability is quite aligned with the farmer lens. I think the language has not matched. And I think when we get, quick sound bites on headlines, they may misrepresent what's really happening on the regulatory piece.
Great. Yes, it just seems that Europe is a little bit more of a hot potato. It's almost like they need to use extreme amounts of fertilizer and supplements for the land mass for the amount of people, or else you're going to be forced to import. Whereas Canada seems to have a vast amount of farmland that supports not only our populace, but, around the world. And I think as you take away the ability to use some of those things, that's what's going to hurt Europe is they just will not have the yields that can sustain their own population.
That could very well be where it's going, which again, further supports that have exposure to Canada thesis for sure.
Yeah. Okay. That was my one question. Obviously, I only have a 1 slide memory, so I was thinking back to the last one.
All right. Well, jumping into just, provides an overview of what we do at Bonnefield. I mentioned we really do view ourselves as a financing solution for farmers. And I think a lot of people, can't necessarily, they can't necessarily grasp, like, why would a farmer want to partner with you? Are you going out and just buying up as much land as you can? And that isn't the case. For the most part, farmers are coming to us directly. We're certainly out in the markets meeting people, but we get emails every day and phone calls every day from farmers who are looking for a way to access additional financing. So, folks who are coming and saying, hey, there's a chunk of land for sale that I can't afford to buy, but I'd love to farm. Can you acquire it for me and lease it back to me on a long-term basis? Or somebody who inherited a farm from a parent, but it's expensive to keep the farm up. Maybe it was underinvested in, and they need to use their capital to invest in equipment, and they just don't have that. So they want to make sure that land stays in, operated by the family. Can we acquire some of that acreage, lease it back to them? They have the capital now to invest in the business. So this is very much, I'd say, farmer led. They're looking for creative solutions to allow them to continue to grow and be really, successful. So the way Bonnefield structures our approach is that we will acquire the farmland. We're creating really diversified portfolios of assets across the country. So we are investing coast to coast, and we think diversification is key to our model. We think that the greatest benefit is being exposed to as many crop types, as many growing regions and climatic conditions across Canada as you can. So we'll acquire some of a farmer's land. We really don't want to acquire a full farm from somebody or all the acreage that they own, because we want alignment. And we really do see ourselves, like I said, a partner and solution, not just an acquirer of land. So we'll acquire some of their land, lease it back to them on a long-term basis. Our leases are primarily a cash lease. So we've agreed to an amount of rental cost that they pay each year, and we get that cash upfront early in the year. It isn't tied to the performance that year. So again, we're really, for the investor, looking to reduce the exposure to the operating volatility that you get in a farm year to year, and just provide that base exposure to the underlying land asset. Our lease, income is very stable. So we have had very few instances where the full lease payment hasn't been made by the farmer across our decade of investment. So the way we structure our leases is fairly, safe from the investment perspective. And then because we are patient capital, we invest in improvements to the land. So that may happen as part of the underwriting process when we're working with the farmer to understand how much we think the land is worth, to understand their needs. Maybe we'll think about doing some tile drainage on the farm. Maybe we'll think about upgrading some irrigation systems. Maybe it's in a rural area and the farm could really benefit. Sorry, not rural, a remote area. And the farm could, really benefit from some on-site storage that they don't have. So we'll think about those things and we'll invest in that. For the most part, those investments have a direct improvement on the appraisal value of the farmland, as well as a subsequent boost in profitability for the farmer. It's able to yield more. Maybe he or she was able to get out on the land, a week earlier and seed, and that made a big difference in their bottom line that year. So that's the type of thing that we bring to the relationship. It's always been really important to us, however, that because we aren't operators, we need to know that we're partnered with really high quality farmers and that they are maintaining the land. So we have, as part of our lease, a set of best practices from an agronomic perspective, things like maintaining regular crop rotations, soil erosion control, watercourse management, the appropriate use of fertilizers and pesticides. That's part of our lease. The farmers report into us, what they planted, what the yields were, what the inputs were. We have property managers who go to site. And then we also have third-party agrologists who conduct audits against the standards of care to ensure that the farmer is in adherence with them. So that, again, from a landlord perspective and from the investor perspective, gives us a lot of oversight to see if there is an issue, if we think that operator may not be maintaining the value of the land by, in the way that they're operating it. We have early opportunities to see that and work to remedy it. We really will work to, partner with the farmer to understand why the issue has arisen and give them time to remedy it. But if they're, if for some reason it can't be remedied, or that operator isn't willing to follow them, then we have the ability to find a new tenant for that farm. And so one of the funds that we manage is eligible for Canadian individual investors. And so that is called Bonnefield Canadian Farmland Evergreen LP. It's an open-ended fund. It was launched in 2010, and it currently sits with $150 million of assets under management. Bonnefield manages about $1.4 billion of farmland in total, but the remainder of that investment is for larger institutional investors. So this fund, you can see, has performed well since inception. So in 2022, it had a net return of 15%. Its since inception return is a little over 8%, and that's net of all fees and expenses, and has outperformed the TSX since its inception. And as I mentioned, we are looking to be very diversified across the country. You can see, meaningful crop diversification. So our farmers do pursue rotations. So this would change year to year, but, 11% last year exposed to canola, 13% to barley. We have, almost 11% in potatoes. We have 20% roughly in soybeans. We also have apples. I believe we have some blueberries in that portfolio. So it's a mix of row crops and permanent crops, as well as some specialty vegetables. And then fairly, good diversification across provinces. Although within provinces, we've also identified really unique regions and investment strategies. So we tend not to do our diversification based solely on provincial boundaries, but this is one of the easier ways to display it when talking about the portfolio. I mentioned a bit of the performance, just to give you a sense, and really, I think, bring to light how farmland performs in the portfolio. We're not targeting 20% returns. I'd love to tell you that every year we're going to get, mid-teens. That is not the case. But in years of higher inflation, you are going to have higher returns. When equities are blowing the lights out, farmland's probably going to be a little bit boring, but it's going to be stable and steady. Farmland historically in Canada really has not declined in value. In slow years, it stays slow or closer to flat. And then in good years, it tends to have a bit more of a jump, but it's a little bit of that slow but steady. And you can see in that scatter plot, we've used our historical returns from our open-ended funds to represent Canadian farmland. And, really the 10-year average return there is competitive and comparable with many other asset classes. But it's that standard deviation. So is so much lower. And really it's that less volatile part of your portfolio. So, a good thing to think about if you are thinking long-term, stable, value preservation, as opposed to, call it income generation. So before I wrap up, I think different investors think about farmland and agriculture for different reasons. Some of them, I'd say all of them are looking for a diversifier. Some are maybe looking more for an inflation hedge. Others as well really, maybe are thinking about that climate change piece. Maybe they're thinking about what climate change is doing to other industries and assets in their portfolio and want to be in a asset that tends to hedge against some of those impacts. And still others, I'd say, are very concerned about the ESG and the sustainability of what they're doing. And they want to know that their investment is, yes, giving them a return, is doing what they expect it to do, but they also want to know that they're investing in something that makes sense to them, that they believe, the dollars are going to support something that is meaningful and valuable. And I think certainly when you talk to our farm tenants, they really do appreciate the service that we bring to the market. And so, it's great to be able to support them in their growth, because agriculture really is an industry that suffers from a lack of investment. So, whatever it is, I think there's a number of different ways that investors can look at agriculture and farmland specifically and have it be a good fit in the portfolio.
Good.
Well, that's excellent, Andrea. I mean, for us, we've kind of approached this from two perspectives, because we have agricultural clients that, it's difficult for them to liquidate a portion of their farm or all of their farm, whatever it is they want to do, and look at retirement. That's a very illiquid asset. So Bonnefield is providing I think you title it the sale leaseback solution. So the ability for the farmer to sell a bit of their land, yet continue to work it, or allow their family members to continue to work it, but liquidate it a bit. I think that's a fantastic solution for them. And then it gives us as portfolio managers an opportunity to provide clients an investment solution where they might want to get into or have a piece of the farming world. So really cool stuff. Thanks for sharing all that. We've got some questions for you if you've got some time for us to pepper you with some questions.
Happy to do it. But before we do, just based on what you've said, one thing I didn't mention is that we do have a land for units option for farm owners. So, there are a number of farmers, as you say, they're looking to maybe over time sell down. They're looking to liquidate some of it. And some of them may want to continue to be invested in farmland. And so if there is a farmer with, a farm that fits, what we're looking for, there may be an opportunity where if Bonnefield acquires it, we can return units of the fund. It also helps to defray some of the immediate capital gain, and allow that investment to continue to appreciate through exposure to the fund. So always, happy to talk to folks about that.
Yeah, interesting. That's a nice idea too. The ability for the farmer to swap his ownership of his farm for ownerships of the Bonnefield fund and start producing an income from the fund instead of going out and working the fields every day.
Well, I think in that situation too, depending on your taxability, there could be a situation. It's you sell, you pay the tax. Mm-hmm. So the opportunity to swap and still stay invested and basically take your farmland and diversify it across Canada and earn a return and be able to trigger your own tax over the years if you want, is a great solution. From us, as wealth advisors, that's, we look at investments like this, but we also spend a lot of time on tax strategy with our clients. So the fact that we specialize in business owners, which includes farmers, having a solution like this is kind of just one more tool as an option for a farmer. They might not choose to do it. They might choose to do it with a portion. They might do a leaseback solution if they're just trying to downsize a bit and want to still farm a portion of their overall farm assets, but maybe they want to take some of that in. And the worst thing you could ever do is have to sell something, pay tax when you don't need the money, when you're still trying to have an income from the remaining amount of your farm. So it's a great solution, I think, and it's a great deferral solution.
One of the questions I had for you, Andrea, was just around risks that you might run into in the fund. I think you touched on it a bit, and it was all around, climate issues, and you're trying to diversify the land ownership across Canada so you're not susceptible to, a drought in one area that wipes out your fund. What other risks might you run into in this type of investment?
Yeah, and we can't guarantee anything, right? Obviously, we've hit our returns, but we can't guarantee those returns, and so there are risks. I think the environmental and the climate change risks are the largest ones. I think the way we've worked to mitigate those is by having the majority, as I said, the majority of the lease payment come up front. We also look at the farmer P&L and understand, their profitability. And our model, it needs to be sustainable for all individuals. It has to, provide a return for the investor, but it has to ensure that the farmer is profitable. And so, we've really never set our lease rates at a point where it isn't sustainable for that farmer. But so from that perspective, we've had weather events on a number of our properties, wipe out years, but there's a really strong crop insurance program in Canada. And so farmers are often compensated that way, and we've been paid our leases as a result. So I think that mitigates it. There's always a risk that there are, government policies potentially that come into play that don't allow this type of investment in farmland. And so the provinces of Saskatchewan and Manitoba actually don't allow the Canadian pension funds or any institutions to have a fund like this invest in those provinces. Individuals still can. And it's certainly something to flag. We don't believe that there's anything on the horizon that would suggest that changes are in play. And I do think that as we see more farmers looking for this type of solution, because we have more farmers thinking about exiting farming, thinking about what is that succession plan, who is buying my land. And we have younger farmers who are trying to take over that land, but they don't want to do it all on the backs of a big mortgage. We think that, there's actually going to be greater opportunity and potentially a swing in the other direction where maybe those provinces open up. But that, I think, would be one of the other risks that I would flag.
Interesting.
Is this fund RSP eligible, the Evergreen Fund?
It isn't, just because it's a CRA rule with land assets that we can't do it, unfortunately. But it is quite tax efficient. So the return stream, and I probably didn't touch on that in too much detail. The primary driver of return here is capital appreciation of the farmland. And one of the things that we do is that we aren't setting the values of the farms. We're not marking the book. We have third-party accredited appraisers who are conducting appraisals of the properties every year. We set a quarterly net asset value on the fund. So we have roughly a quarter of the properties appraised each quarter. And that's how you kind of mark the ongoing value appreciation of the farmland. We're also earning lease income. And then we are trimming positions. We have farmers who come to us and say, hey, I'd like to buy back some land, or we have neighbors and local farmers who may want to acquire assets. And as we think about that portfolio construction, there are areas where we may want to sell some of the assets down a bit to invest in other areas. So we'll do some asset sales, and then there's capital appreciation on that sale. So the investors themselves, they can choose to receive a distribution each year, a cash distribution, and we target between 1% to 3% of their committed capital. Or they can do it as a distribution reinvestment. And really that distribution is treated as a return of capital. So it lowers their adjusted cost base. And then the other return piece within the investment is treated as capital gains. So it is tax efficient because there's no income tax that's coming through to the investor.
Great. Is this a competitive market, Andrea? Are you guys up against a bunch of other providers that do this sort of the sale leaseback solutions and then offering units to shareholders or investors?
I'd say no. When we are in the market talking to people about doing this type of a solution, we have never come across another investment manager. The folks we see buying land are farmers. Those are, I'd say, the people who typically would want those acres if their neighbor would sell to them, rather than, working with Bonnefield. With that said, there are new players coming into the space. The majority of them, I'd say, are very regionally focused. So they focus on just, a very specific kind of small part of Canada. And then there are others who are doing a different type of model, more of a private equity joint venture where they're actually operating the farms. And so we don't run into them either because we're really trusting the farmer. They're the experts. We're backing high quality operators and letting them do their thing. I sit in Toronto. Nobody should phone me during harvest to approve an expense. That's crazy. So I'd say, we don't see too much of this activity in the market. Certainly in other geographies in the world, there are some, there's a lot of groups that are doing this. But we represent, less than 1% of Canadian, the value of Canadian farmland in terms of what we're doing. And so, I think even if there were additional folks coming into the market, they would probably be welcomed by a lot of farmers to have that additional source of financing. And, from the investor perspective, I think that should be a real attraction because this isn't an asset class yet that is really frothy, that is being, having pricing put into it by speculative investors. That just isn't happening. It's trading on its fundamentals of farmer to farmer transactions.
Great.
One of I know from our past discussions that we have talked about is the hold period, and if we were as advisors talking to our clients about the liquidity of this investment, it's one of the restrictive parts that we would say, when we're constructing a portfolio, definitely an asset class we would want to add, but we have to be cognizant of how much do we put into an asset class at this because of the hold period. So maybe just discuss investing in something like this, why the hold period is what it is, and what impact that would have on, I guess, risk.
Absolutely. And so, two things I'd point to. One, farmland is a very slow moving asset class. I talked about those appraisals that happen, and those are setting the value for the fund. We only, we have one appraisal per year on a property because you don't see many transactions in the region in a given year. And frankly, in some areas that we invest in, it may take 3 or 4 years until you see enough comparable sales that would get the appraiser to say, okay, let's move it from here to here. So that's something to take into mind. And if you're going to be invested in an asset class like this, you want to be invested through a typical cycle. And for us, 8 years is probably enough time to see, a reasonable amount of growth in farmland. The other thing that we need to think about is that we're making long-term commitments to our farmers. We want to make sure that our capital is available to them and that we don't have to start selling assets because people want to be redeeming, on a quarterly basis. That just doesn't work. It is an illiquid asset. So you have to match the hold period to the asset class itself. I'm hesitant to talk too much about what our current structure is on hold because we're in the process of likely changing it. But I will say, right now, as it sits, we have a 3-year hard hold. And then between years 3 and 8, the redemption price is calculated at a discount to NAV. We are very likely to be reducing that fairly meaningfully, but still ensuring that the hold period is sufficient for the asset. So very likely to go to a 2 and 5 model. Now, as an investor, when you think about that, on one hand, you may say, but what if I need those assets? Fair enough. It's probably not the asset class you need to be investing in if you think you're going to have a need for those assets within 2 years. Where I think investors don't necessarily immediately go is that there's actually almost, a reduction in risk that comes with some of this illiquidity, because those slides I showed previously, think about what's happening in those markets at any given time. You want to be alongside other like-minded investors who want to be in this asset for the long term. They're not going to be rushing out and trying to redeem in periods of high market volatility, either, to make up losses in other parts of the portfolio or to be very opportunistic. We heard a lot earlier this year and the end of last year about different real estate funds that were putting up the redemption gates. And this was the type of market where you saw, people saying, no, you can't redeem. And that has an impact on the results of the fund. And so, if you don't have the same like-minded long-term investor base with you in the fund, you can start to lose some of those diversification benefits because people are coming in and out. So, I think that's just something to think about. But you're right, Dave. I mean, this may not be the right fit for everybody with the hold period on it. But to the extent that you are thinking about it, I think you kind of, think about it as that longer term value preservation and use other parts of the portfolio to maybe try to drive some of those near-term returns.
Yeah, I would agree. I mean, obviously, this is one asset. I mean, we do use a lot of other alternative assets in our pool, and obviously, there's liquidity issues with some of those as well. But this probably would be on the longer side for that. So we factor that in when we contemplate using this. But I think like all pools that we're active in, if somebody really needs their money, sometimes there's that opportunity when we have new assets coming in. Everybody wins in that one because someone gets some assets that already have a certain clock running on that asset that we swap out for someone else. So the money stays in the pool. We're just substituting a different investor in for it's, kind of like a pinch runner, I guess, if you want to call it.
Absolutely.
And
unit transfers are allowable. Yeah. So that,
awesome.
I think for us, it's just to make sure, and I know for you to know that, the investors and your clients go into it knowing the length of hold and that's right for what they're looking to achieve.
For sure. What else you got there, Tyler? You've been writing furiously.
I've been writing, but it's interesting, Andrea. Every time I write something down, you answer my question before I get to ask it. So you've obviously done this presentation before and you know what to expect. So I appreciate all your comments here. I don't have any other questions or stuff on my side, Dave.
I think that was a really good overview and a really good discussion about it. And I'm sure we'll be talking again in the future about these types of things. So, yeah.
Yeah. So thank you very much for being here, Andrea. Is there any other comments you want to make about Bonnefield, or you done it?
No, I think that's it. I really appreciate the opportunity, and we're always happy to meet with people and talk more about what we're doing. And gents, maybe we'll get you out to one of our farms sometime soon. You can tour around.
Right on.
Awesome.
Yeah, it is a unique product, and we've been interested in following it and learning more about it. So we appreciate you sharing your thoughts with us and with our viewers today, Andrea. And if you want to learn more about us, you can catch us at smokinbowls.com or follow us on social media. Thanks everybody to watching, and make sure you like our videos and subscribe. Thanks, Andrea, and we'll talk to you soon.